Hey there, everyone, and welcome to the Final Bar. Happy Monday. It's May 6th, and I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the benefits of technical analysis. And the benefits are many, folks. This is all about what the markets are telling us in the form of price action, breadth indicators, momentum indicators, sentiment readings, all those things that help us better understand what is happening and really what is moving, where the opportunities may be. Last week was a volatile week, ended up resolving in a position of strength. Friday last week finished pretty strong with risk assets having a decent finish to the week, coming through earnings, coming to a Fed meeting. Today, a little more of the same. The major averages having a nice rally through the end of the day. Really, most of the day was more constructive than not. So we have a lot of charts to look at. Breadth indicators, which we'll dig into a little bit later in the show, really starting to improve a little bit. So is this the beginning of that recovery back to new all-time highs and more? Does Q2 follow the strength of Q1? And is the pullback phase behind us? Let's look at the charts together and see what we can answer here as we get to our market recap. Before we get to the charts, by the way, I do want to let you know about a poll we had recently on our social media accounts. How many rate cuts do you think the Fed will make in 2024? Last week, of course, we had the Fed meeting, Powell's press conference. This came up quite a bit in the press conference after, a lot of commentary related to it. 35% of you calling nothing this year. 2024 will be a year of no rate cuts. 39%, the most common response, is one rate cut for the year. Two getting 21% of the vote, and just a handful of us thinking there might be more than that. You know, it's interesting. If you look at the Fed's FedWatch tool, that's actually a free website that they manage. And years ago, there wasn't a FedWatch tool that was this beautiful, website to allow you to understand it. So I remember having an Excel spreadsheet which would draw in data from the Fed funds futures and try to interpolate where the market was pricing in certain cuts. And that's what this FedWatch tool is now doing for you on its own. You know, if you look at the data right now, the June meeting, which will be the next meeting, 92% of a chance of no change in the Fed policy. July meeting, about a 69% no change. So even through the July meeting, the market now pricing in no change to rates. You have to wait till the September meeting. There's no meeting in August, but you wait till September, only 34% chance of no change, 49% of a chance of a 25 basis point cut, and that's the most the strongest one. So the market really, if you look at the Fed funds futures, we don't have time to go through all the nuances of the percentages I'm sharing with you, but it's basically taking the Fed funds futures and where they're trading to see where the market is pricing in potential rate cuts through year-end. Market's pricing in 2 cuts through year-end, which is fascinating because 6 months ago, we're talking about multiple. I mean, we're talking about 3, 4+ rate cuts and debating how soon they will be. Now that starting line is pushed down to the September meeting, according to the markets here. And a lot of you responding seem to be more along those lines, that we will have very few rate cuts. They most likely start a little later. What does that mean now? That means rates most likely remaining elevated if we continue to see inflationary pressures, if we continue to have no change in Fed policy, rates most likely remaining a little bit higher for longer. So think about how that might impact all the things we're going to look at from here on out. Let's go to the dashboard here on Stockcharts.com. We'll see the S&P 500 finishing just about 1% higher. You'll see in the little preview chart for most of the equity indexes, nice rally in the last 30 minutes of trading. We always try to focus just a little bit on that because that's where a lot of big institutions will tend to make moves. They wouldn't do it during the day, sort of wait till the end of the day to minimize impact on the market when you're trying to move a lot of volume. And so, sort of accumulation is the general takeaway going into the end of the day. S&P 500 finishing 1% higher to 5181, we'll call it. The NASDAQ composite about 1.2% higher. Mid-caps leading the way with 1.4% to the upside for the S&P 400. Look at how the VIX now comfortably below 15. Didn't change too much today, to be honest with you, just slightly below where we were on Friday's close. But as I mentioned, I think on last Thursday's show, every day you see the VIX remain below 15. At least to me, that means less and less likelihood that we see further deterioration from here, because low volatility is not what tends to happen when the markets are rolling over, right? When the markets sell off, when people are getting nervous, that is the definition of volatility increasing. That's where when people get nervous, that's when the VIX pops, because they're uncomfortable and they're taking quick action because of their fear of the market going down. volatility increases, markets go down. We're seeing the opposite. We're seeing actually volatility remain relatively low, and below 15 is a nice, comfortable, low volatility range for the VIX. Looking at interest rates, kind of a noisy day here after a noisy Friday, a lot of movement, but directionally we really didn't make any big moves one way or the other. You can see the yield curve essentially not much of a change from Friday's close. 10-year yield pretty much the same, around 4, just below 4.5%. Same for the 5-year point. The long bond a little higher, around 464, and the short end of the curve, of course, still elevated. The TLT, we'll look at that chart here in a few moments if we can. Up about 0.4%. The dollar index, not much of a change from Friday's close. Commodities all in the green, and one of the interesting takeaways I've had with some of the conversations with my guests, recognizing the short-term weakness in commodities. Crude oil, of course, dipping below $80 a barrel over the last week. Gold prices coming down from all-time highs, pulling back. Same with silver prices today. They're actually pushing back to the upside. And you know, one of the things to look for, that sort of commodity trade really flourished in Q1. You had materials, energy doing quite well. We've sort of seen a mean reversion, right? A rotation away from those sectors in the short term. Certainly the month of April is May a return to that move. I think you'd have to see more and more green on this particular page of leading commodity ETFs. Gold and silver, strong day, copper, crude oil, natural gas, all doing just fine. Mixed results today for cryptocurrencies, but you can see Bitcoin managed to have a decent weekend, finishing, or actually as we're doing the show here now on Monday afternoon, just above $63,000 per Bitcoin. It got up to almost 66K in the last 12 hours or so, but during the equity trading session, sort of drifted lower. Ethereum prices down a little bit as well, but well above 3,000 now. We've been remaining below there for quite some time. You can see the remainder sort of mixed, but overall higher than we were on Friday's close the last time we did the show. Let's go to the 11 S&P sectors. You can see it's all good, all in the green, although these lower ones slightly made it above the zero level, but they got it done. Communication services is your top performing sector, up 1.4%. The XLF financials up 1.3%. Technology, number 3, up 1.2%. On the downside, everything up, but real estate and consumer staples, just a rounding error above zero. You can see healthcare, number 3 from the bottom, 0.4% higher. You know, our market trend model as of Friday's close, all green, and that's one of the big sort of changes I think we've observed here in the last week or two. During that April pullback, a lot of the short-term readings, at least during the week, had turned negative. And at one point, I think all 4 of those were negative in the short term as recently as last week. But by Friday's close, all of them going back positive. The S&P is the main market trend model that I run, and that is, at this point, long and strong up and to the right, all conditions in the green there. Looking at the Magnificent Seven and Friends, sort of these 8 leading mega cap growth names, you can see NVIDIA at the top of the list up 3.8%. Meta and Netflix both up about 3% today. So strong day for some of these leading growth names that, again, represent a lot of market cap. And that's, you know, if you're wondering why the indexes are doing so well today going into the close, names like this having decent up days is certainly going to get it done. Apple down 0.9%, and that's an interesting sort of theme to pay attention to. We'll get to that chart later in our market recap, time permitting. But after gapping higher on earnings, earnings was after the close Thursday. Friday, we gapped higher but closed lower. The question today was, do you see enough of buyers coming back in and pushing prices above that Friday close? Didn't happen. Today, we actually traded lower a little bit more. So that initial optimism we saw after the Apple earnings now kind of being sold off. You're seeing traders fading that gap higher. Alphabet up about 0.5%. Amazon up 1.3% as well. Let's go to a daily chart of the S&P 500. You know, my bear flag, potential bear flag pattern here, starting to look less and less like a bear flag because we've ripped higher on Friday and followed through higher today. We're just barely outside of that flag pattern. So I'm going to leave it on here for now, but it's feeling less and less like the actual path here. So a flag pattern, a bull flag pattern, I'm just drawing this very quickly. Excuse me, a bear flag, correct myself there. A bear flag pattern is where you have a big down move, then you have a counter trend move to the upside of higher highs and higher lows. And the reason why I keep calling it a potential bear flag pattern, why I didn't say this is a bear flag, we all need to start selling, is because to complete and to validate a pattern like this, you need to actually break out of the pattern. You need to break down through the downside. When I'm teaching technical analysis, by the way, I always tell people with price patterns, any price patterns like a flag pattern, a pennant pattern, a triangle, cup and handle, head and shoulders, any of those kind of things, there are 3 parts to that, right? And we often forget that. Part number 1 is the setup, which I think we've completed, which means it starts to look like a bear flag, right? You're seeing the big move, you're seeing the counter trend rally, it starts to feel like a bear flag. Then we have to wait for step 2, which is the trigger, right? We actually break out of that pattern. A pattern like this isn't a valid pattern until we break out to the downside. So until we break that lower trend line, it's not a bear flag. It's a potential bear flag, but it really isn't there yet. And then step 3 is confirmation, right? Once you actually break down through the pattern, do you get further validation of additional selling? And that's something I learned from the great Larry Williams, who hopefully we'll be talking to here in Redmond in the next couple of weeks. Working on getting him out here for a visit to Stockcharts HQ. Tom DeMarco, who I worked with early in my career, they were big. And John Murphy, to be honest with you, all big on follow through, right? Once you have a move, what's that additional validation that it wasn't just a fluke, wasn't just a whipsaw? So we only got that first part. We only got the setup. We never really got that that trigger or the confirmation on this pattern. So still looking to see. Today we, of course, are closing slightly above that pattern. We continue higher. It's not a bear flag. That just isn't what it is. But you know, tomorrow we rotate lower. If we remain in this general range, I'm still looking for a breakdown to validate that pattern. Even with this rally, getting us back above the 50-day moving average for the first time since mid-April. The RSI is still below 60, so not quite in the bullish range yet, but getting there. So, you know, again, this is a really interesting time. I think this is very much a question mark time as to whether we are able to regain the previous all-time highs or whether we're still in this consolidation phase. And I tell you, when I suggest one of those, whoever thinks the opposite, you're vocal about it, and I get it. I think there's strong evidence on both sides, to be honest with you. And I'm seeing a lot of people skeptical of this rally off the mid-April low. We'll see what the markets actually tell us. Let's make sure we be patient and wait for the markets to give their signal. You know, looking at the non-equity markets here briefly, I just want to touch on very quickly the TLT bond prices. So we talked about the 10-year yield, $TNX. Last week, I talked to Gina Martin-Adams. We looked at the, actually that was a 2-year chart I think I looked at with Gina with relative performance of technology, which is a really interesting chart she brought with her. But looking at bond prices in the form of the TLT, this is really just an ETF tracking Treasury bonds, long end of the curve, generally speaking. You know, as I'm looking at this bounce off of the late April rally, again, similar to what you saw at the S&P, I still see this as momentum in more of the bearish range. It still feels like a counter trend rally off of the lows. And now we have this confluence of moving average resistance not too far, about a point above current level. So the bear case for here means you find resistance at moving average resistance. We find we find resistance at those moving averages, that confluence of resistance here around 91, 91.50. And the RSI remains below 60. That's kind of the bear case here. And if that doesn't happen, if you see a break above moving averages on stronger momentum, that means we're now probably in an uptrend, right? And a higher low would be really something to validate that new uptrend phase. But again, TLT, I don't think really giving enough of a reversal signal. Still feels like a counter trend rally by my reading based on this time frame we're talking about. Just to finish off, let's look at some of the individual names. Again, a lot of earnings happening. We're sort of winding down through Q1 earnings here, second week in May, but a lot of companies still reporting. Today after the close, Palantir Technologies, PLTR. We're going to look at that chart right here. You know, it's interesting when you look at the chart of PLTR. Let's get to this one here. I drew this, horizontal line, which illustrates the technical concept of polarity. Polarity is where resistance becomes support and or support becomes resistance. A level has meaning, and so when we're below, we tend to find resistance. When we break through that level, that tends to be pretty meaningful, and we test it from above. And that's right just above $20 a share. We first reached that in the early August of last year, and remember, this is when the markets were topping out and rolling over. PLTR only pulled back briefly, found support around $14, and then started to mount a bit of a recovery. We stalled out in November. We finally broke out with the gap in early February. And now look, this pullback has taken us back to that same resistance level. This is why when stocks start to pull back, I immediately look to the left and start to find key levels of support, key levels of resistance, and draw those lines on your chart. I would encourage you to think of charts as a conversation you're having with the market, not as just something to bring up and look at and it's all nice and pretty like a painting. Like get in there, draw some notes, put some comments on the chart, save them to a chart list. That's how you're actually going to learn the lessons of how market behavior evolves over time. So with PLTR going into earnings today, 8% higher, nice move back above the 50-day moving average, but I like the bounce off of that support just above $20 a share a couple weeks ago. I think that's the real story here as we most likely continue on to new highs. We'll see. Lucid is one I've been asked about before, and again, charts like this, some of the EV makers just are getting absolutely crushed, and not recently. I mean, recently LCID has bounced higher. It's up almost 10% today and back above the 50-day moving average. That's encouraging. However, I think the real story is the fact that this stock has been going down pretty much since inception. If you look at the weekly chart, here's the IPO in late 2020. We had that huge initial surge in early 21. We sort of made a double top pattern in the fourth quarter of 21. And then from there, it's pretty much been a straight downward slope with occasional tests of a descending 200-day moving average that have 100% of the time failed. So when I'm looking at this daily chart, yeah, it's great that we're bouncing higher. Yes, that's a big percent move on a stock trading less than $5 a share, but stocks like this, I think, need to prove themselves by getting above the 200-day moving average, change that long-term multi-year negative trend that we've been observing. I haven't seen enough to get too excited about this chart just yet. Just to finish off here, I want to look at a couple of these magnificent 7 stocks here, just maybe 2 or 3 of them. Netflix is this one right here. And as you look at the chart of Netflix, I just want to highlight with some of these with Netflix, I think with NVIDIA as well, they're holding some key support levels. This is 550 on Netflix. When we gapped higher in January, we opened just below there. We ended up closing right around 550, and that was the retest in mid-February. We then got all the way up here to sort of 630, 640, before gapping below the 50-day, but look at how we held that same support level. And again, that's why I like to draw some of these horizontal lines, just to capture levels where I feel like the market has memory, where the market is telling you that that level has meaning. It certainly is the case for now, and 550 continuing to hold. So I think that's your floor for now. We'll see if it can get above the 50-day moving average, and if so, I would think a retest of that all-time high from early April, very, very likely. It's up 3% today. Still needs to get above the 50-day, but I like holding support there at 550. And to the downside, I often ask my guests, what would you need to see to turn, to change your mind? I think a stock like this breaking below 550, there's your next big leg lower for equities, as if a Netflix can't hold support. It's if an NVIDIA can't hold support around 750 or so. I'll get the chart I have here with some of the notations. Here's NVIDIA testing support right around 750, and again, that's taking it from that gap in late February. That lines up with resistance in mid-February. That lines up almost perfectly with the low from mid-April, and then indeed, we're back to retesting the previous all-time high. So NVIDIA actually a nice long-term structure. I don't think the long-term structure has been in question here. It's been more about the short-term sort of tactical picture, but for now, holding support kind of at a very expected level. Just to finish off here, let's look at the Apple. Apple, of course, reporting on Thursday after the close. Again, I sort of have mixed feelings about what we learned there. I don't think the quarter was particularly good, particularly iPhone sales that came in at a 10% weaker than previously reported. And so that's not great, but you have a higher dividend, you have a record buyback, and that, I think that combination powered this gap higher, but it was sold through the course of the day on Friday, and additional selling happening today. So compare that to some of these other names with an earnings win, and then you see additional accumulation. This concerns me on a chart like Apple, where a positive surprise, a positive reaction is met by selling, not met by additional buying. For now, the 200-day moving average back in play for Apple. That's it for our market recap. And again, just touching on some of the key charts top of mind for me as I'm going through the trading day today. We're going to do a segment in a moment called Banking on Breadth, where we dig a little deeper into the market breadth conditions. So we'll go through some of the charts that I like to follow there. It's getting more encouraging, by the way. Before we do that, just one quick announcement. We would love to hear from you. We did an all mailbag show on Friday of last week. It was a lot of fun answering some really thoughtful questions from all of you. Keep them coming, won't you? Our email is thefinalbar@stockcharts.com. We're on X @finalbarsctv. And here on YouTube, just put a comment in the comment section below the video. We would love to hear from you, particularly your questions, and we'll hope to answer one of yours in our next mailbag show. Should be Friday of this week. As a reminder, by the way, I'll be taking off after the show today, heading to San Francisco, speaking at the Money Show. So if you will be attending that event in Silicon Valley, please make sure you say hello and that you watch the show. It'll be a pleasure to meet you in person. Let's continue on here with our next segment, banking on breadth. Let's look at some of the major breadth indicators that I like to follow. As a reminder, as we're going through some of these charts, I like to tell people for a macro technical perspective, I think of it as three general parts in order of priority. Price is number one. So one of my mentors, Ralph Acampora, told me, if you know nothing else about the markets, know the daily S&P 500 chart. That tells you most of what you need to know. And that was great guidance years ago. It's continued to serve me quite well. Focus your attention there first. Everything else should come after that. Second phase to the macro technical perspective are breadth conditions, right? Which tells you about participation. If the major benchmarks are doing X, what about the individual stocks that make up those indexes? Because a lot of times at major turning points, the index will do one thing, but breadth conditions will do something different because stocks are actually changing character, even though the benchmarks don't reflect that. And then third, to that tertiary, I would say in importance would be sentiment, market sentiment indicators like survey data and positioning data. I think of those as more illustrative, more descriptive than anything, but I rely on the first two primarily. So now that we've talked about the major benchmarks, this nice counter trend rally that is feeling less and less like a counter trend move and the more like a primary trend higher if we can continue to push above the 50-day moving average through the course of this week. Let's talk about the market breadth conditions. So we'll go through a series of charts here just to kind of highlight where the breadth is at. We're going to start with the S&P 500 and breadth by cap tiers. So cap tiers are basically looking at different groups of stocks grouped by their market cap ranges. So we have the New York Stock Exchange broad advanced decline lines. This is a pretty broad, diverse group of stocks. Then we have S&P large cap, S&P mid cap, and S&P small cap. So the main indicator I look at is here at the top. And this is essentially looking at the common stocks that are listed on the New York Stock Exchange every day, how many close up, how many close down. You keep a running total of those changes, and that turns into a cumulative advanced decline line, which is what we're seeing here. By the way, all the charts we're looking at are part of my Mindful Investor live chart list, so we'll have a link in the description for you to access that if you're not familiar with that list. A lot of the charts I refer to on the show are derived from the charts on that list there. So the New York Stock Exchange common stock advanced decline line here in the top panel, overall back above the 50-day moving average. I think that's positive, but not quite to a new March high. And that thing that I just said, that particular configuration is the exact same for large cap, for mid cap, for small cap. That's why they're all color-coded, sort of a neutral amber color here. They're bearish for me when they start to break to a new swing low. Really didn't get that yet from any of these indications, but and they're green when we break to new highs because that tells you there's more accumulation. But when we break to new highs and then violate the 50-day moving average, I turn them to neutral amber, which is where we're at today. So through the course of this week, what I would be looking for here, if you're looking for an all clear, if you're looking for Dave to say, wow, that's it, we're long and strong going up and to the right, these lines making new highs, I would switch them to color-coded green. That would be what I would be looking for here. So what that could do, and if you think about it, the S&P, of course, still below its all-time high. Closing high was around 52.50 and change. These advanced decline lines could theoretically actually break out first, and that's why we're looking for these four to see if they can power higher. Because what that would tell you is that there's enough accumulation during trading days, and not just one day, but actually multiple days over time, powering a lot of these individual stocks higher. That's what would cause our benchmarks to do well, most likely, is if breadth conditions are improving from here. The McClellan oscillator kind of takes that raw advanced decline data, but then turns it into more of an oscillator, a short-term indicator of strength or weakness. And very simply, if the McClellan oscillator is above zero, I think of the short-term breadth as being constructive. If the McClellan oscillator is below zero, it is more negative. And I've color-coded, the way I like to look at it is color-coding the entire region, so you can see how the McClellan oscillator being above or below zero, how that tends to relate to price movements. And I will tell you, so far in 2024, particularly Q1, it was not incredibly helpful because what would happen was you would go below zero and the market would still end up going higher. And I would attribute that to the dominance of those mega cap names, right? It's, even if some of the smaller names were breaking down a little bit, the biggest names were still getting it done, and that's what's allowing the market to go much, much higher, even though the McClellan oscillator was more neutral, more choppy. Now, we did get a good sell signal at the end of March, beginning of April, which this indicated that the breadth was rotating lower, and of course, a lot of things sort of pulled back there in April. May so far starting to improve a little bit. Really, the last week in April, now into the first, second week in May, starting to get a lot less negative, a lot more positive. You can see the McClellan oscillator really chopped around the zero line for the last week and a half. But as of Friday's close, sort of nice, decisive move into the positive region. We don't have this updated for today's close just yet, but based on the evidence I've seen on today's trading, most likely continues to go higher from here. So the McClellan oscillator is giving more of a thumbs up, all clear. Now, this is more of a short-term breadth reading. So the way I would use this going forward is you've now gotten a thumbs up green. This tells you the market is now in a bullish configuration. Look for a break below the zero line. It's as simple as that. And that often you think, all right, would that be too late? Not usually, right? Because the breadth actually turns negative because it's actually looking at the change in breadth. It's not just looking at the absolute breadth data. So the McClellan oscillator tends to go below zero while the market's actually still in an uptrend. It's just the breadth conditions are weakening. So that can often be sort of an early warning sign. For now, it's sort of a thumbs up bullish reading. This is looking at stocks making new 52-week highs and new 52-week lows. And the bottom two panels are showing you that daily reading. Green are new 52-week highs, red are new 52-week lows. We're doing it for the entire New York Stock Exchange, and then we're doing it for the S&P 500. I like this breadth reading, or this breadth indicator, because what it does really tells you about leadership, right? For the market to really go higher, if you think the S&P is going to go higher and test 5,500 before Q2 is done, you're going to have a lot of stocks making new 52-week highs. Even if the S&P is making its way higher, you need those early leaders that are already doing well, right? You need the NVIDIAs and super microcomputers. I'm thinking back to Q1, right? Those AI stocks that just were ripping higher. And even though some stocks were not doing well, there were enough names moving up that it was creating this upswing in the markets. And that's what you're starting to see in the last 2 weeks. You're seeing more and more green. You're seeing less and less red. I would want to see more and more of that. I think the bullish story from here would involve more green, which means more 52-week highs, less red, meaning less stocks actually breaking down. We're seeing maybe the beginnings of that here over the last 2 weeks, but the month of May would need to see sort of a steady increase would be the ideal situation. Look back to like November into December of last year is a good example of the kind of breadth thrust you would need to see, which basically means an influx of positive movements leading stocks making new 52-week highs. We're getting there, but not enough where it really feels like a super bullish reading just yet. This is maybe one of the more important ones I'm going to show you here. This is the percent of stocks above their 200-day moving average, currently at 74%. Percent of stocks above their 50-day moving average, currently just above 50% as of today's close. Now, we broke below that 50% level second week in April. That was one of the many bullet points telling me we're in a pullback phase and thinking about downside objectives because the S&P had broken down through its own 50-day moving average and a bunch of individual names had done the same. This indicator remains bearish as long as it remains below 50%. I think that was one of the great signals back here in August of last year when it broke below the 50% line, remained there all the way through the second week in November where it finally gave an all clear and said enough stocks are regaining their 50-day that the market probably has enough upside momentum or enough participation to move higher. So looking for a similar sort of condition, maybe we've had it here, right? With the S&P bouncing higher than NASDAQ, a lot of individual names doing well, all 11 S&P sectors higher today. A lot of individual stocks are now regaining their 50-day moving average. And just think about what the numbers mean. A couple weeks ago, right, third week in April, we're down around 30%. Now we're just about 50%, which means about a fifth of the S&P, about 20%, about 100 stocks within that group of leading names have gone, we're below their 50-day moving average, now back above it. So that shows you there's been a bit of a positive development. So it's interesting. I certainly would tell you as we're going through some of these breadth conditions, they're less negative than they were. Some of them are actually starting to look outright bullish, to be clear with you. Just finishing off here briefly, the bullish percent indexes. The S&P's bullish percent, for me, sort of a lack of signal. The last signal here was a sell signal in early April when it broke out of that 70% range. Also note the divergence here between January and March with the market moving higher, but a lot less stocks in a bullish phase there at the end of March. But the real classic sell signal for me is when we're we're over 70% that we come back below, and that has often been a really good counter trend signal. That's what we saw at the beginning of April. Really told us that downtrend was a likely scenario. For now, it's sort of neutral, kind of in the middle. But look at what's not neutral. And I did get some pushback for this one. I posted something about this last week. I had some people telling me that, I think more you're bearish, so you don't want to believe that that's a bullish signal. I get it, because I'm in the same mindset. Generally speaking, I'm thinking the market probably has further to go, but I can't deny the evidence, right? And I think that's the point of technical analysis. Technical analysis is not about gathering evidence to support your conclusions. It's about gathering evidence and then drawing conclusions from that evidence. And it's a weight of the evidence. Some things will disagree with your point of view. Even though I've been bearish here on stocks here recently, the fact that the bullish percent index on the NASDAQ 100 got all the way below 30% and then back above it. This was about a week and a half ago. You can see previous times when that's happened, those have been pretty tradable lows. And for now, that's what we're seeing. Now, there's no guarantee that we don't just rotate back lower and make another undercut of that level. But what that indicator basically told me is at least we're going to get a counter trend bounce to the upside. So for the last week, it's been following through nicely off of that level. So keep an eye on this one, because though there's so much market cap represented in the NASDAQ 100 names. These are your leading growth stocks. These are the AI trades. These are the Magnificent Seven and a lot of more friends. This keeps going up. There's your bullish point of view. I mean, there's your bullish evidence, because that tells you that more and more of those leading growth names are having buy signals on their point and figure chart. That only happens when the conditions are improving. So out of all the indicators I'm going to show you, maybe that's the most important one. All right, that is it for Banking on Breadth, and indeed, that's it for our show. Thanks so much for joining us every weekday after the close. I'll be on the road at the Money Show in San Francisco, planning to give you a show every day. So hang with us as we do some weird publishing schedules given that show. But for Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.